War is an algorithm. We will show its price. In 2023, Lebanon earned $5.4 billion from tourism. That figure represented 25% of the country's entire GDP. By late 2024, hotel occupancy had dropped to 10%. Hotel revenue fell 80 to 85%. The tourism sector, the single largest source of hard currency in a dollarized economy, went to zero in months. No missile hit the tourists. No bomb landed on a hotel. The damage was done by perception, by fear, by the rational decision of millions of people to stop traveling to a country at war. Tourism is the most fragile pillar any economy can build its recovery on. And war destroys it faster than almost any other sector. Not through physical damage, but through the invisible mechanism of risk assessment. We are going to calculate what that costs. The structure of tourism dependency. Tourism-dependent economies share a common vulnerability. The revenue is foreign currency, the hardest asset for a developing economy to earn. It employs disproportionate numbers of people across multiple sectors: hotels, restaurants, transportation, retail, services. And it is almost entirely driven by confidence. One security event, one travel advisory, one war on the evening news, and the entire sector can collapse overnight. This is not a niche risk. It is a structural one. Countries that have built their economies around tourism revenues have, in effect, built them around a single variable that they cannot control: the perception of safety in the minds of foreign travelers. Lebanon is the case study. Egypt is the historical precedent. And the pattern repeats with predictable regularity across every conflict zone in the world. Lebanon, from 8 billion to zero. Before the Syrian war, Lebanon's tourism industry generated over $8 billion annually, accounting for nearly 20% of GDP and employing roughly 18% of the active workforce. Beirut was one of the most cosmopolitan cities in the Middle East. Tourism was not just an industry, it was the economic identity of the country. The Syrian war began in 2011. Lebanese tourism revenue dropped steadily through the decade. Then the financial crisis hit in 2019. Then COVID. Each shock reduced the sector further. By 2023, tourism had partially recovered, $5.4 billion in receipts, a sign that the industry could still regenerate. Then the 2024 war began. According to the Institute of International Finance, tourism accounted for 20% of Lebanon's GDP before the conflict and came to a complete halt during it. Hotels recorded an 80 to 85% plunge in revenue. Occupancy dropped to 10% nationwide. Employment in hotels halved. Over 50 airlines suspended flights to Beirut. The Lebanese Federation for Tourism stated that tourism was at nearly zero. The World Bank's March 2025 assessment placed the total economic impact of the conflict at $14 billion, $6.8 billion in physical damage, and $7.2 billion in economic losses. Commerce, industry, and tourism sectors combined lost an estimated $3.4 billion. Lebanon's real GDP contracted by 7.1% in 2024, a figure the World Bank attributed primarily to the collapse of private consumption driven by tourism, remittances, and displacement. They said, tourism will recover once the fighting stops. They got a sector that has been hit by 4 separate shocks in 13 years: the Syrian war, the financial crisis, COVID, and the 2024 war. Each time it recovered partially. Each time the recovery took longer. The cumulative GDP decline since 2019 approached 40% by end of 2024. Tourism was not the only cause, but it was one of the largest. Egypt, the Arab Spring's economic wound. Egypt's experience with tourism disruption predates Lebanon's by over a decade and illustrates what happens when a tourism-dependent economy is hit repeatedly. Before the 2011 revolution, Egypt welcomed 13.8 million tourists per year, generating $9.8 billion in revenue. Tourism accounted for 6% of GDP and 10 to 15% of employment. It was one of Egypt's largest sources of foreign currency, alongside Suez Canal fees, remittances, and oil exports. The revolution cut tourist arrivals by 33% in a single year. Duration of stays fell 23%. Spending per day dropped from $85 to $72. GDP growth collapsed from 5.1% in 2010 to 1.8% in 2011. Unemployment rose from 9% to 11.9%. The low point came in fiscal year 2013 to 14, when fewer than 8 million tourists visited Egypt, and tourism revenues fell to $5.1 billion, roughly half of pre-revolution levels. According to Carnegie Endowment analysis, 2013 was the worst year on record for Egypt's tourism industry. The sector did not recover. It was hit again by the 2015 Metrojet bombing over Sinai, which killed 224 people. Russia imposed a blanket ban on flights to Egypt. British authorities followed. Arrivals dropped to 9 million. Revenue stalled. Egypt's economy has not fully recovered from the 2011 revolution in tourism terms. The sector has been rebuilt around different source markets and different destinations within the country, but the scale, the revenue, and the employment that existed before 2011 have not returned to pre-disruption levels. The multiplier problem. Tourism revenue is not just the money spent by tourists. It is the money that money generates as it moves through the economy. Each dollar spent in a hotel becomes wages for staff, purchases from local suppliers, tax revenue for the government, and income for families who spend it on food, education, and services. The multiplier effect for tourism spending in developing economies typically runs between 1.5 and 2.5. That means $5.4 billion in tourism receipts generates between $8 billion and $13.5 billion in total economic activity. When that $5.4 billion disappears, as it did in Lebanon in 2024, the actual economic damage is not $5.4 billion. It is closer to $10 billion or more. This multiplier effect is why tourism collapse hits disproportionately hard in economies that depend on it. The sector does not just shrink. It pulls down every sector connected to it: hospitality, food service, transportation, retail, real estate, construction. The ripple effect reaches parts of the economy that have no direct connection to foreign visitors. The recovery timeline. Tourism recovery after conflict follows a predictable but painful pattern. In the first year after fighting stops, arrivals remain near zero. Travel advisories remain in place. Insurance premiums for the region remain elevated. Airlines do not restore routes until demand justifies the investment. Hotels do not reopen until occupancy projections justify the operating costs. In the second and third years, some recovery begins, usually from diaspora visitors and regional travelers willing to accept higher risk. Revenue remains well below pre-conflict levels. Employment in the sector stays depressed. Full recovery, if it happens at all, typically takes 5 to 10 years. And even then, it requires the absence of further disruption. Lebanon's tourism industry has been hit 4 times in 13 years. Each recovery cycle was shorter than the last, because the base from which recovery began was lower each time. The remittance connection. Tourism and remittances are linked in ways that compound the damage. In Lebanon, remittances represented roughly 30% of GDP before the conflict. Tourism revenue represented another 20 to 25%. Together, they accounted for more than half of the country's hard currency flows. When both collapsed simultaneously, as they did in 2024, when displacement disrupted remittance networks and tourism went to zero, the country loses its entire mechanism for earning foreign currency. Imports become impossible to pay for. The currency collapses. Inflation accelerates. The economy dollarizes further, and the cycle locks in. This is not a sequential process. Tourism collapse, remittance disruption, and currency devaluation happen simultaneously. Each accelerates the others. The result is a speed of economic deterioration that no single factor can explain, but that the combination of tourism dependency and conflict produces reliably. The final calculation. Lebanon. Tourism revenue went from 5.4 billion to near zero in months. GDP contracted 7.1%. Cumulative GDP decline since 2019 reached 40%. Egypt. Tourism revenue halved after 2011. The sector has not fully recovered 14 years later. GDP growth dropped from 5.1% to 1.8% in 1 year. The pattern is consistent. Tourism-dependent economies are structurally vulnerable to conflict, not because war destroys hotels and airports, but because it destroys confidence. And confidence, once lost in a tourism market, takes years to rebuild, if it can be rebuilt at all. War does not just destroy infrastructure, it destroys the invisible asset that tourism runs on, the belief that a place is safe to visit. Subscribe to What War Costs. The cost that disappears fastest is always the one that was never tangible to begin with.